Let's talk to Patrick Reid. He's the co-founder of Adamis Principle. Very good morning to you, young Patrick.
Hi Nick, how you doing?
Living the dream, it's Friday. Right, 4 thought-provoking slides. Let's kick off with the first one. Let's put you on the soapbox. What are your thoughts on the US dollar against Japanese yen on an hourly chart? This is a very short-term time frame for you.
I know, it very is. But you know, the big thing everyone's talking about is yen getting selling and dollar yen being the main recipient. Obviously, there's a bit of broad dollar strength, but this is what all the desks are talking about in the last few days, especially this week. So this is why I put the hourly on. The key level that broke was 111.50 area. Okay, so I just want to sort of talk about what's in store. You know, we're clearly trending, and you know, a lot of my students are saying, well, if you say the trend is your friend, well, when is it the end? And there's no let up for this. You know, trends go on far longer than you can remain solvent.
Yep.
So it's just, all I can say is I don't know when it's going to end, but just what I try and do is look at the clues. Is it above the short term, i.e. the hourly moving averages? Yes. Has it corrected below the 38%? No. Is it still consolidating at the highs? Yes. Therefore, you do not want to be selling into this.
That all sounds very sensible. In terms of the next slide, the weekly, how high can this go? I spoke to a commentator today and he was talking an upside target in his mind, round of 125.
Yeah, you may wait a little while for that. And don't forget, trade wars is still on the wings in the theatre, ready to pounce at any point. You know, you got Trump one tweet, 2 tweets, another 200, another 300 yards in trade tariffs. So let's not get too carried away. 125, 113.20, massive level. That's the next target. So we've got pretty much clear water up to there. Above that, obviously, you've got 114, 114.50 area, very sticky up there. But I'm just not really thinking about upside targets where I'd be selling. I'd be looking to buying into dips.
Right.
The key massive level is 110.20 for a whole host of reasons.
So that's basically support below the market, right?
Yes.
Understood. Yep. So until that's broken, you're thinking buy any dips, okay, you're on the ball.
Absolutely. Yeah, I mean, I blogged it on LinkedIn a few days ago. I think I bought 111.26 area. You know, and as you were basically until the market tells you it's exhausted,
yep,
and it's tired and it hasn't done that yet, just buy the dips.
Understood. Okay, so let's move on to the next slide. So we've got a spread chart here, differential between the 2 and 10-year money. In terms of the yields, lots of commentators are talking about when this basically goes below zero, it predicts a recession. The flip side to this is people have said we've never had quantitative easing before. What are your thoughts there?
Okay, so this is a chart I don't need to show you, Nick. You've been around, you know what's what. This is a chart I've been banning around for many decades, and many commentators say, oh, we're getting close to an inversion. Inversion is an indicator to an imminent recession.
Yeah.
Well, that's all well and good. However, in the last minutes, the Fed discounted this as not a great indicator for a recession. They have subsequently replaced it with the next chart. And the next chart is basically, so it's out with the 2s and 10s spread.
Yep.
It's in the 0 to 6 quarter spreads in futures. So it's super near term. And this basically positions them to potentially hang a future hawkish hat. In addition to this, it discounts any of the creaking doves that still bring out the 2 and 10 spread to say, well, you know, this is worrying, you know, and like you said, we're very distorted in price because of QE. And, you know, look at the main FCI, the Financial Conditions Index. We're still in a very easy time.
Okay, so in summary, okay, we're going long dollar yen. We're ignoring the 2 and 10 year. and we're saying we're looking at the basically FOMC are looking at a different indicator because it's different this time around.
Absolutely, and my guess is obviously I see PCE just because of the comments on ISM being primarily not a demand issue but an aggregate supply issue. I see that being related into hard data and the prices getting a massive lift on PCE and CPI. Therefore, I see there's a new bird in town and it's flying straight at you. It's a hawk.
On that note, young Patrick, thought-provoking as always. We'll talk to you same time next week. Thank you.
Thanks, Nick. Thank you.